welcome to the Science of Business channel, home of the Velocity Pricing System, which you can find at www.velocitypricingsystem.com. I'm Bo Gaines, the Throughput Accounting Guru, and I have with me Brad Stillon, the inventor of the Velocity Pricing System. Now in this video, we're going to discuss a major mistake many job shops are making in their pricing. This is job shop pricing mistake number 1, giving away productivity improvements. So Brad, back when I was a controller at a job shop, if I ran a job cost report, or if I was even looking at a quote when we were doing our pricing, I would have seen something like this. This would be for a job, we would have had revenue of $10,000, job cost of about $7,000, and a gross margin of $3,000 or 30%. And that's kind of typical. Now, what would also be true is that we were, on the lean bandwagon. We were trying to do all these things and make all these improvements. And there's nothing wrong with any of that. You have to do that. You need to be improving. And so occasionally, a broken clock's right twice a day, we would actually make productivity improvements, lo and behold. Now, the result of doing that is when we go back and look at our times, the time it takes to do the job improves. And so if we go back into quoting this same job into the future, our ERP is going to grab the new time reflecting the productivity improvements. Or if we have an astute estimator, they're going to do the same thing. Use the new time as lower because we've had the productivity improvements and begin to work with that as their time assumption. Now, when that process plays out, invariably what happens is the estimator arrives at the new margin and they go, whoa, check out this. We made all these productivity improvements, and that could be buying a machine, setup reduction, any number of things like that. But when they look at the margin, they're going to say, man, because of that productivity improvement, our margin is no longer 30%. It's much higher. You know what I'm going to do? Watch this, Brad. It's going to be pretty cool. We can make more money and at the same time give our customer a discount. I'm going to charge $9,500 for this job, and because our job cost went from $7,000 to $6,000, we can earn a gross margin of $3,500 or about 36.8%. So I can give our customer a discount, and at the same time, we're going to make an extra $500 or an extra 7% on this job. That's awesome. What do you think about that, Brad?
I think it's a mirage. What I don't like it as a former business owner is that when you do this, you end up making less money, but you're very happy about it. You don't know any better.
Yeah, I mean, come on, man. Brad, you're bursting my bubble. The gross margin said it went from $3,000 to $3,500. What do you mean we're making less money?
Well, what expenses did you reduce? Who did you fire? So if you have the same expenses yet you're charging $500 less, how can it be that you're making more money?
Did you not want to ask the hard questions on the video, Brad? Yeah, I see your point. So you don't fire anybody. You don't get rid of any overhead expense. You just charged $500 less. Now, Brad, I know this and you know this, but folks that are using cost accounting, they don't know this. When you run that job report again, even with having given away $500 of a quote-unquote discount, and it's all done in I would say a good faith effort, because when you do this discount, what's playing in the back of your mind, the siren song is, we can give the customer a discount and they're going to give us more work and we're going to make it up on volume. And it never happens. And the problem is, if you're using cost accounting to do your pricing with and evaluate the performance of jobs, you will never see this happen. Never. Not in a million years. So Brad, let me kind of explain to the group here what's going on and how we look at this in the velocity pricing system. So what we've added 2 columns, and the 2 columns on the right-hand side of this, columns 4 and 5, those give you the perspective that we would have in the velocity pricing system. Now, we calculate margin a little bit differently. We do not allocate direct labor or overhead to a job. Now, we're going to do a separate video and go into detail there about all that, but suffice it to say, we have a different, better way to calculate margin. Now, the same job in the initial setting still had the same $10,000 of revenue, our methodology would have had $3,000 of job cost and a margin of $7,000. Now, we don't calculate margin percents. We don't use that to evaluate profitability. But what we can do is look at the effect of the pricing change here. In our methodology in velocity pricing system, we would see that the revenue fell to $9,500. However, the job cost did not change. But look what happened to the margin. It dropped. Lo and behold, the same $500 that you gave away in the form of a discount is showing up right here with $500 less margin. Now, that is the power of the velocity pricing system. When you use cost accounting is lying to you. It's telling you you are making more money when in fact you're making less money. And that's what's so good about the velocity pricing system is that it gives you the clarity to actually see what's really happening in your business. And Brad, for me, I know, as a CPA and management accountant and all this was a total departure from how I had done it, what the textbooks say, and everything else. But once I wrapped my head around what you developed in the velocity pricing system, it was so much more powerful, so much simpler, and it actually led me in the right direction to make better decisions.
Well, it's such common practice, and 99+% of businesses in the world do it the cost accounting way. So doing it the different way with more clarity, most assuredly should help make you more money and give you a competitive advantage at the same time.
Yep. So if you're doing cost accounting for pricing, and you can see it here, the effect of this is that yes, when you do and you make productivity improvements, you can in fact do more work in less time. However, because of that price decrease that you just gave away in the form of a discount, you just let your productivity improvements walk right out the door. And in so doing, what you're going to find is that in about 3 to 6 months post productivity improvement, you're going to find your business in the exact same spot. You're going to be working, you're going to be maxed out and hardly making any money, and definitely not making the money that you think you should be given how hard you're working. So this is the siren song of the cost accounting world. Make sure this doesn't happen to you in your business. And Brad, I'll share here quickly a little trick that one of the tricks we use to safeguard against this. But basically, when you make productivity improvements, stick with the old pricing. It's that simple. And that way you ensure that you're not giving away these productivity improvements and that you hang on to them and take them straight to the bottom line. So guys, that's all we got in this video. So if you like this video, hit the thumbs up button, subscribe, and come back for more great content. And until next time, head on over to www.velocitypricingsystem.com so you can see what we're all about and how we can help you make more money. Thanks.